So guys, today we have to start from long-term borrowings. It's a part of non-current liabilities, the first item of non-current liabilities. Long-term borrowings are those borrowings means business has taken loan, right? So when a company takes a loan, either from banks or from financial institutions or from the public in form of debentures. What is debentures? We'll talk about that later. A company can also take loan directly from the public by issuing them some certificates which are known as debt instruments. Technically, we call them debentures. So suppose I have a company and I require rupees 1 crore. Instead of taking 1 crore rupees from bank or from any financial institution, I can go to public. I can give an advertisement in the newspaper mentioning that I require this much of money, and for that I am going to issue certificates, and those certificates are debentures, and each certificate is of rupees 100. Each certificate is of rupees 100, right? So 1 crore divided by 100, it means 1 lakh certificates I am going to issue to public. Those who want to purchase my certificates, they can purchase. In the advertisement, I also mentioned that when I will repay the money to the public. Today, I am taking money as a borrowing, that is as a loan from the public. I also need to mention when will I repay the money, right? I also need to mention in that advertisement as until I pay the money, how much interest every year I will pay and what would be the frequency of that interest. I may pay 1 year interest in one shot or may pay it in four equal parts, that is quarterly payment of interest or half yearly payment of interest. Am I clear, guys, or not? So, if a company takes a loan where the repayment of loan is due after 1 year from the date of balance sheet, then such loan is long-term borrowings. Have you understood, guys, or not? Suppose today my company has taken loan, right? Today is 21st August 2023, right? Now, for this year, I will make the balance sheet on 31st March 2024 because the year that is going on as of now is 23-24. Right. So on 31st March 2024, when I will make the balance sheet, if that day, from that day after 1 year, that is after 31st March 2025, I would be repaying this loan, then that loan I will show in my balance sheet as long-term borrowings. I hope you all have understood this, guys. Right, Mansha, Mishika, Manya, Tanmay. A company can also take loan from subsidiary companies. Tata Consultancy Services can take loan from Tata Motors or from Tata Steel, right? So when a company borrows, that is takes loan from banks, financial institutions, public directors of the company or subsidiary companies where repayment of the loan is due after 1 year from the date of balance sheet, it is called long-term borrowings for the company. I hope guys you all have understood this. Right, Mansha, Manya, Mishika, Tanmay, and those who are sitting here.
Yes, sir.
Yes, sir.
The next item that we have in our balance sheet under non-current liabilities is deferred tax liability net. You first note down about long-term borrowings. Companies Here, this one. And under non-current liabilities, after long-term borrowings, the next item is deferred tax liability net, right? So let's understand about that. Now, in the liability side, we have deferred tax liability net, and the asset side, we have deferred tax asset net, right? What is this? Let's understand this, guys. Now, guys, listen to me carefully. We have two different acts applicable to companies. One is Companies Act 2013, and another is the Income Tax Act 1961. Income Tax Act 1961 is applicable to all the businesses, whether you have a proprietorship business or partnership or a company. You have to pay tax to the government, that is income tax, on your net profits according to the rules given in Income Tax Act 1961. Are you understanding, guys? I repeat, you have a business, whether it is a proprietorship business or partnership business or a company, you have to pay income tax on your net profit as per the rules of Income Tax Act 1961. Right? That is applicable to companies also. Companies, apart from this, are also liable to make their financial statements, that is, statement of P&L account and balance sheet, as per the rules given in the Companies Act 2013. It means every company has to make its statement of P&L twice in two different ways. One for Companies Act, another for Income Tax Act 1961. Are you understanding, guys? One which is made as per the Companies Act 2013 is submitted with the Company Law Board. If you have a company, every year financial statement you have to submit with Company Law Board. If you do not submit, there would be penalty on you. If you have a business other than a company, you have to submit your P&L statement every year to Income Tax Department. For companies, they have to submit statement of P&L to Company Law Board as well as to Income Tax Department. Is it clear? I'm asking, guys. Now, when they prepare the two statements, that is P&L statement for Companies Act and P&L statement for Income Tax Act, both the statements show different amount of net profit because the provisions of the two acts are different. For example, Income Tax Act does not consider provision for doubtful debts as an expense at all. In class 11th, you all have learned that on the debit side of P&L account, we write two bad debts, add provision for doubtful debts. Do you remember this or not? Right. Bad debts is your actual loss. Provision for doubtful debt is your probable loss, which may happen in the next year. But this year only you record it, right? Income tax department does not consider that as a loss at all. So when you prepare being a company statement of P&L for Income Tax Act to be submitted it to Income Tax Department, you cannot show provision for doubtful debts in your P&L statement at all. Are you understanding this, Mansha, Mishika, Manya, and Tanmay, what I said? I'm asking, guys, have you understood what I said?
Yes.
Yes, sir.
Everyone, Mishika, Tanmay,
Yes,
Manya.
sir.
It means, so this is one of the reasons because of which profitability of a company as per Companies Act and as per Income Tax Act would be different. Because in Companies Act, when you prepare P&L statement, you have to show provision for doubtful debts, right? But in income tax, for Income Tax Department, you cannot show provision for doubtful debts. This is the one reason. Second reason for you people to understand is that Companies Act has given different rates of depreciation for different types of assets. Those rates only you have to apply to depreciate your assets. For plant, it has different rate. For machinery, different. For furniture, different rate. For furniture, different rate. For computers, different rate. For other intangible assets, different rate. Right? The same type of rates have been given by Income Tax Department, but rates are different. Means Companies Act has given one schedule of different rates of depreciation for different assets. The same way, income tax also has published one schedule in which for different assets they have different rates. It means amount of depreciation on a single asset as per Companies Act and as per Income Tax Act would be different. And because of that, net profit would be different. Are you understanding this, guys, or not? Okay. One more difference is that Income Tax Act says that you should charge depreciation only using written down value method. You cannot apply straight line method. क्लास 11 में पढ़ा है आपने स्ट्रेट लाइन और WDV मेथड. As per Income Tax Act, you have to apply depreciation on assets of your business, whether it is a company or proprietorship or a partnership business, only as per written down value method. In Companies Act, they have given both the rates, SLM rate and WDV rate. If you want to apply SLM, then you have different rates. If you want to apply WDV, you have different rates. Am I clear? But in income tax, they have given only one rate, that is as per WDV, and you have to apply WDV method only. So because of this also, there is difference in the profitability of a business because of two different acts and their different rules. Is it clear or not? I'm asking guys all, right? What is deferred tax liability or deferred tax asset? Let's understand with an example, with this context which I just explained with you, with this background, right? Accounting profits, that is as per Companies Act, and tax profits as per Income Tax Act. Accounting profits means as per Companies Act, where we do normal accounting, which you have learned in class 11, where we charge provision for depreciation, where we can charge depreciation as per SLM or as per WDV. But Income Tax Act has different rules. So let's say in the year 2021-22, and here the year is 22-23, the accounting profits of a business of a company are rupees 10,000, whereas income tax profits are rupees 12,000. Correct? Now you have to pay income tax to the government based on this profit only. You do not have to pay income tax to the income tax department based on this profit. Why? Because for payment of or for determination of tax amount only, we have this act. How much tax you have to pay, that income tax will decide and not Companies Act will decide. Clear guys or not? Who charges income tax? Income tax department, not Companies Act department. Means not company law board. So tax rate as per Income Tax Act for companies as of now, it is 25%. For all Indian companies, they have to pay straight 25% income tax on their net profit. Even though you have profit of 1 rupee, you have to pay 25% of that. You have profit of 1 crore, you have to pay 25 lakhs to the government. Right? So here that would be how much? 4,000. 25% of 12,000, 25% means one fourth. One fourth of 12,000 is 3,000, right? Yeah, 3,000. Right? But tax on accounting profit. The profit that we are showing in our P&L statement, which we have made for the public and for the Companies Act, on that if we apply this 25% tax, then that would be how much? 25% of 10,000, that is 2,500. Correct or not? You are a company, you have a company. You are making your statement of P&L as per the Companies Act, where the net profit is 10,000. Listen to me carefully, guys. Now we are going to talk about deferred tax liability. आपकी कंपनी है एक, आपकी कंपनी में एक पर्टिकुलर ईयर में इन द ईयर 2021-22 you have earned, your company has earned net profit of 10,000, right? You are making your statement of P&L as per the Companies Act, and that statement only is published to the public. The statement which is published is not the one which is made as per Income Tax Act. Statement of P&L which is made as per Income Tax Act has very limited role. Its role is only to determine the amount of tax to be paid to the government. That's it. But for all other purposes, companies have to prepare P&L statement as per Companies Act. So P&L statement as per Companies Act is reflecting net profit of 10,000. But how much tax you have to pay? 3,000. Correct? And 3,000 is not 25% of 10,000. So what companies do for this is that they debit statement of profit and loss account with 3,000, because that is the, sorry, with 2,500. That is the 25% of their accounting profit. The accounting profit which is reflecting in their statement of P&L as per Companies Act. So in statement of P&L as per Companies Act, how much net profit is reflecting? 10,000. So 25% of that is how much? 2,500. It means in the debit side of statement of P&L at the end, as per the Companies Act, they will show tax amount of 2,500. But how much tax they have to pay to the government is 3,000. So they credit provision for tax account with 3,000 rupees. The difference of 2,500 and 3,000, they debit to deferred tax. They debit it to deferred tax account with 500, which is difference of 3,000 minus 2,500. So this 500 guys reflect as an asset because it has a debit balance. So it is deferred tax asset, not liability. Am I clear? Right?
Excuse me, sir.
Yes, Mancha.
Sir, can you explain the journal alone?
Yeah, see, you have made your P&L statement. You have a company. You have made your P&L statement as per the Companies Act, in which the net profit is 10,000 rupees, and everyone knows that the income tax charges tax at the rate of 25% on the net profit of Indian companies. It means your statement of P&L should show tax amount of 2,500, and that will go on the debit side of P&L account, and that is why we have debited statement of P&L with 2,500. Clear till here?
Yes, sir.
But how much tax exactly you have to pay to the income tax department is 25% of tax profits. And tax profit is 12,000. So 25% of that is 3,000. So you have to make provision for tax in your books of 3,000, because this is the amount that you have to pay to the government. Correct?
Yes, sir.
So the difference of this 2,500 and 3,000 is debited to an account which is called deferred tax account. And this deferred tax account, since it has debit balance, that is why it is an asset. Have you
Yes,
got
sir.
this now? Okay. Now let's say next year accounting profit is 12,000 and income tax profit or tax profit is 10,000. Means accounting profit is more than the actual tax liability profit. Because this is the profit on which tax liability would be ascertained. Income tax department will never ask 25% of 12,000. It will always ask 25% of the profit that has been arrived at as per the rules of Income Tax Act. Correct? So next year our tax rate, sorry, tax as per Income Tax Act would be how much? 25% of 10,000, that is 2,500. Right? Okay. So that you do not have any confusion, I am making it 11,000. Right? So 25% of 11,000 is how much? 2,750. Am I clear? Whereas tax on accounting profit. Tax on accounting profit. What is accounting profit? 12,000. 25% of that is 3,000. So in the year 2022-23, this is the journal entry that the company will pass in 2021-22. And in the year 2022-23, the company will pass the following entry. That is statement of P&L account debit. Which is statement of P&L? The one which is made as per the Companies Act. What is the profit reflecting in statement of Companies Act is 12,000. So 25% of that profit is how much? 3,000. So here we will debit 3,000. But how much actual tax we have to pay to the government is 2750. So that would be created to provision for tax. Now this time the difference is on the credit side. So for that we will credit to deferred tax account. And that is how much? 250. Am I clear? So every year deferred tax account may have different balance, means balance on either debit side or here we have on the credit side. Are you getting my point, guys, or not? Now, from the previous year, from the year 2021-22, we have debit balance coming in the accounting year 22-23 of rupees 500. Of rupees how much? 500. This year we have created deferred tax account with 250. So what is the net balance non deferred tax account is? 250 debit balance. Again, it would be shown as an asset. On the balance sheet, which we will make on 31st March 2023, we will show deferred tax account in the asset side as 250. Am I clear, guys, or not? Now, next year in the year 2020,
Sir, isn't
23,
that credit? Excuse
sorry,
me, sir.
yeah, Mancha.
Isn't that deferred tax two deferred tax supposed to come on the liability side?
No, why two? See, deferred tax account is one account only. On 31st March 2022, deferred tax account had debit balance of how much? 500, which was carried forward to the accounting year 22-23, right? And in 22-23, deferred
Yes,
tax
sir.
account has been created with 250. So now the net balance in deferred tax account is 500 debit minus 250 credit, that is 250 debit, which is an asset.
Yes, sir.
So here also it is an asset. Am I clear that or not?
Yes, sir.
Okay, let's say in the year 2023-24, accounting profit is rupees 15,000, but tax profit is only 11,000. For example, right? This is the accounting profit and this is the tax profit. So tax amount of tax on income tax would be 2750, right? On the amount of income tax profit is 2750, that is 25% of 11,000. But here it would be 25% of 15,000, that is 3750. So for the year 2023-24, the entry that will pass is 3750 here. Here it would be 2750, so difference is 1000. After doing this, now the net balance and deferred tax account would be 1000 credit minus the previous balance 250 debit, that is 750 credit. So now this will become a liability. And that is why we use the term net, whether it is liability or asset, because every year asset and liability get net off. Am I clear, guys, or not? I'm asking. Manveer, have you got this? Here. Mansha, understood this now? Mansha, Mishika, and Manya. In the first year, we had more profits as per Income Tax Act than the Companies Act. So the difference of the two was debited to deferred tax account, which is our asset. Next year, as per Income Tax Act, the amount of tax was 2750. That is, it was lesser than the amount of tax according to according to Companies Act, and that is why the difference of these two was created to deferred tax account. Next year again the same story was repeated, that is, tax as per income tax was lesser than the tax as per Companies Act. That is why the difference was created to deferred tax account, and because of this, now on 31st March 2024, we have credit balance in deferred tax account, and that is why it is a liability. So in the first 2 years, on 31st March 2022 and 31st March 2023, we will have deferred tax asset only in asset side of rupees 500 and rupees 250 respectively. But in the balance sheet of 31st March 2024, now we will have no more deferred tax asset in the asset side of the balance sheet, but we will have deferred tax liability of rupees 750. Am I clear or not, guys? Now I'm asking all
Yes,
those who
sir.
are here everyone, right? So in balance sheet of a company, either you will have deferred tax liability or you will have deferred tax asset. Both can never be there in same balance sheet, guys. And this asset and liability keeps changing. Now, the other thing, guys, going ahead. This is not actual liability of the business at all. This liability business does not need to pay to anyone. It is only because of the difference of tax as per Income Tax Act and tax as per Companies Act. So neither it is an liability nor it is an actual asset which the business has to recover from somebody. No. I hope guys you all have got this. Right, Tanmay? Understood this? Deferred tax liability and deferred tax asset. Tanmay Khandelwal, I'm asking you.
Yes, sir.
I hope you are with us, right?
Sir.
So guys, now you can start noting it down. Everything I've explained and that only I'm writing here. So guys, I have written everything that I just explained you. You note down this, go through this thoroughly, take some time and go through the example also and tell me still if you have any doubt, I will clarify those. I hope guys you have noted down everything from here and not missed anything, right? And I can scroll it down. Everyone, right? Note down this also, guys. Mansha, Manya, Mishika, Tanmay, you're also done with this.
Yes, sir.
Yes, sir.
Okay, the third item, guys, under non-current liabilities is other long-term liabilities, or simply long-term liabilities. Our first item was long-term borrowings. This item is long-term liabilities. Now, in case of borrowings, we get money and we have to repay money. In case of liabilities, we get something else, but we have to repay money. And that too in long term, right? So what comes under this is that under this comes those installments which are still due to be paid to suppliers for purchase of fixed asset on long-term installment basis. Suppose a company has purchased a machinery of rupees 50 lakhs on an installment basis of 5 years. So the installments which are falling due after 1 year from the date of balance sheet, they all would be shown under this title. Am I clear? Are you getting my point, guys, or not? Those who are online, they also have understood this, right, guys?
Yes, sir.
Yes.
So it includes liabilities on account of installments to be paid for purchase of fixed assets on installment credit basis after 1 year from the date of balance sheet. And the last item that we have, guys, is long-term provisions. Who can tell me, guys, why do we make provisions? Forget about long-term provisions. I'm simply asking about provisions.
Sir, concept of prudence.
Why does a business makes provision? Why does a business make provisions? Yes, Tanman.
Sir, concept of prudence.
Sorry?
Prudence. That 14 principles.
No, no, that is the principle. Why do we make provisions? But for what we make provisions?
Like incoming liability for our incoming liability, which may affect our business in future.
Incoming liability means
Like for example, workman compensation claim. It's a liability towards the workman, so we have to pay him. And if in a case we don't have the cash or something, so that's why we make provision.
no. If we know the liability that there is a liability, then we will record that liability as outstanding liability. Why to make provisions then? And even here, guys, why do we make provisions? Right, very correct. It is not fully correct, but yeah, everything that you told is correct. Guys, provisions are made for those expenses and losses which we know that they are going to take place for sure, or they have already taken place, but the amount of which is not known to us accurately. राइट इन हिंदी वो सारे एक्सपेंसेस या लॉसेस जो हमें पता है या तो हो चुके हैं या होने वाले हैं पक्का फॉर श्योर लेकिन उनका अमाउंट हमें एक्यूरेटली नहीं पता है उसके लिए हम प्रोविजंस बनाते हैं आई होप यू ऑल हैव गॉट दिस गाइस नाउ you must understand, or you should know this, guys, that every business has to pay some retirement benefits to its employees according to labor laws of India. For example, if an employee works for you in continuity for 5 years or more, then he becomes eligible for gratuity. Even though you have a business in private sector, you are not a government company, you are not a government department at all, then also you have to pay to an employee gratuity once he retires if he has worked for you for 5 years in continuity. Am I clear? So suppose in my company some employees are working for more than 5 years, they're still with me. I know that once they will get retired, let's say at the age of 60 or before that even, one fine day they say that now I do not want to do the job, or I want to shift to some other company. That day I have to pay him a compensation that is called gratuity. Am I clear? If you are a government company or a government department, then you have to pay pension and provident fund also to them. But if you are a private company, like other companies are, the usual companies are there, what we see around like Reliance Industries or Tata Motors, they all have to pay gratuity to their employees, those who work for them for at least 5 years. Am I clear or not? And that compensation is a big amount. Now, suppose after 10 years down the line, an employee is going to get retired and he has already worked for me for more than 5 years. So I know that this much of amount I have to pay. When he gets retired, can I arrange that big amount at once? I cannot. So every year from my profits, I keep making provision so that once or on the time of his retirement, I have good amount of funds with me, which I will pay to him. Without arranging those funds from outside, I already have the funds with me because I already made provision, and by making provision, I subtracted my profits, I decreased my profits, and I paid lesser dividend to my owners. And this is how I saved cash for compensation to that employee. I hope, guys, you have understood this. Mansha, Manya, Mishika, Tanmay, have you got this or not? So
Yes,
Yes,
sir.
sir.
provisions which are to be discharged or to be repaid after 1 year from the date of balance sheet are long-term provisions, and these provisions mainly include provision for compensation to employees. I'm not talking about workman compensation, guys. No, that is different thing. That compensation you have to pay when an employee becomes sick or gets disabled permanently or temporarily while working in your business. आपकी कंपनी में काम करते हो, मशीन में उसकी उंगली कट गई या हाथ कट गया या उसकी डेथ हो गई और he falls sick, you have to pay him a big amount of compensation, but that is different compensation. That you have to pay only when such event occurs. But retirement benefit you have to pay for sure. तो पता ही है आपको देना. You know that you have to pay this much of big amount, right? That amount, for your information, guys, is calculated based on last salary of every employee. The month he retires or he leaves the job, that month what was his salary, on based on that, yes, his compensation is calculated. Have you got me, guys, or not? You can start noting down this, guys. Tahir and Amatullah, this class is not for you, but anyways, you can stay here. Why? Because in next 2-3 minutes we'll start with macroeconomics, right? So guys, this is how we have seen all the four items which fall under non-current liabilities. We'll start with the third item, that is current liabilities. We are done with all non-current liabilities, right guys?